Back to our top story now and those Chinese growth figures. And to discuss them a little more, I'm joined by Todd Martin from Societe Generale in Hong Kong. Todd, thanks for your time.
Thanks for having me, Phil.
Well, they're calling it a slowdown. I mean, how convincing a slowdown do you think this is?
Well, I think things have been slowing down slower for several months. Second quarter GDP came in at 9.5%, consensus was 9.2, and that's down from 9.7 in first quarter. I think the major thing is that we have seen an acceleration on a quarter-on-quarter basis from 2.1% in first quarter to 2.2. So things aren't really slowing down as fast as people maybe were expecting, and I think that's what affected equity markets today.
Well, most people were expecting, for example, a slowdown in industrial production. We didn't get that. So what is that telling us?
Well, it's telling us a few things. Industrial production came in over 15%. Consensus was for 13. Tells you that heavy industry is doing well. You're seeing things like autos, steel, also power, where people were expecting in second quarter that some of the power shortages were going to start affecting that sector, and that hasn't been coming through either. So that's powering on. And then you're also seeing retail that came in at 17.7%, showing you that domestic consumption is also going fairly strong. So it tells you that PBOC in China doesn't have to rethink what it's doing, but might want to rethink how much it's been hiking interest rates. Despite that, the sort of verbal response we've been getting from the PBOC and Wen Jiabao, the premier, is that they are very likely not to use interest rates, that we're probably going to see one or two more reserve requirement hikes. They're using forward-looking language, and it just sounds like they want to go on a slight pause and see how things pan out over the next few months.
Well, of course, one of the issues China has is balancing growth with the need to combat inflation. I mean, officials have said, as you would know, that attacking inflation is a top priority. But do you really believe them in the sense that they need to allow the economy to grow at a reasonable rate to avoid social unrest, don't they?
Yes, they do. And if anything, where the language has been shifting from the PBOC is more this idea of not only controlling inflation, but this idea of balancing growth. And this re-emphasis on growth seems to be coming into the language more recently, which is why, the Societe Generale Economics Department doesn't believe that we're going to see any more rate hikes, at least through the rest of the year, and that we'll just probably see one or two more reserve requirement hikes, despite the fact that you have, deposit rates at 3.5%. And inflation up above 6%, so you're getting negative real rate return. But despite this, it does seem that this emphasis on growth and this idea of balance is coming to the fore. So it's sounding quite dovish, quite frankly.
So what do you expect is going to happen to inflation in China? It sounds like it could become a major problem.
Well, yeah, I mean, back in 2006, 2007, the PBOC did go on a pause, and you ended up with CPI ripping through. I think, obviously, that they want to avoid that this time. Last month, we had very strong pork prices, 57%. So that was one of the reasons that was laid into why food was still putting pressure. Despite this, I mean, the base effects for last month were pretty strong, and our guys are still looking for CPI to fall from the the mid-6 range and start going back down into the 5 range, but you're still up and over the 4% target the PBOC sets out. So they've got a long way to go. So credit growth is slowing year on year to 15%. It does seem that we're heading towards some sort of a soft/bumpy landing, but despite that, we saw very, very strong June numbers coming out of the property developers. Overall physical property prices tend to be going up on a low single-digit basis in most cities. I think they'd like to see that to flatten out. So it'll be interesting to see. 2 reserve requirement hikes, I just can't see that really putting things under control. So I think PBOC is going to be, I think they're willing to live in a world of CPI in the 5% range for now. That seems to be what their message is telling us.
Well, you were saying a while ago that China's economic progress could be quite lumpy. I mean, do you rule out a hard landing now?
No, we're not ruling that out, but I think that still remains in the 20% or below chance range. There are other structural issues, such as the local government debt problem that has been recently. They had an audit report came out, and we have over 10 trillion renminbi of exposure there in the banking system. So I think China's going to focus on that. They're going to focus on resource price reform and some other themes. So
okay.
The idea is that.
Todd, I'm sorry, we're going to have to leave it there. We've run out of time. Thank you.
Appreciate it.